Hi, everyone. I am CS Vivek Banerjee, and I will be taking today's session on valuation of equity shares, which is part of the security valuation chapter. The topic security valuation consists of two parts, valuation of equity shares and valuation of bonds. So today I will be taking the valuation of equity shares. Before proceeding to the various concepts of the valuation of equity shares, uh, let us recap whatever we have studied in this regard. If you can remember, in the topic on fundamental analysis, we have discussed the various aspects of fundamental analysis, that is economic analysis, industry analysis, company analysis. So just take a quick recap. In economic analysis, for example, we see whether the GDP growth rate is good or not. If the GDP growth rate is good and it is projected to be good in the next 6 months or so, then we can see very well project that the industries will also do well. So after economic analysis, we come to industry analysis. And if we analyze further, we see that the sector which the government is giving push, big infrastructure push. So if the government is giving big infrastructure push, the sectors which are likely to do well is the steel sector, cement sector, iron ore, some real estate companies. These are likely to do well. And the PLI scheme also, the production linked incentive schemes of the government, in which the government is giving subsidy to those domestic companies which are in the domestic manufacturers actually. So these are also likely to do well. The government is giving a big push to the electric vehicle sector. So the automobiles companies who are pursuing electric vehicles on a large scale are also likely to do well. And the last but not the least, the banking sector also, because of the RBI's pressure, the most of the banks are now reducing their non-performing assets NPAs. So some of the banking sectors also likely to do well. Now, after this industry analysis, we narrowed it down to the company analysis. Yes, the banking sector is likely to do well, but what are the companies? Which companies an investor as a fundamental analyst should look into? These will result into going into deep into the financial analysis and the quality of management. These two main factors. The other factors also which we have discussed, primarily these two are the main factors. Financial analysis. In the financial analysis, we have seen that before proceeding to purchase the equity shares of a particular company, fundamental analyst do a thorough profitability analysis, that whether the sales growth is 15% or more during the last 5 or 10 years. Profitability growth is 10 to 15% the last 10 years or so, 5 to 10 years or so. The return on capital employed ratio is good or not, the return on equity share ratio is good or not. Then the fundamental analysts come to the liquidity analysis, in which the interest coverage ratio is calculated. Interest coverage ratio gives a good amount of, you can say, picture about the liquidity of the company, whether the company has sufficient cash or not. So if the EBIT is at least covering thrice of the interest amount, so it will be, you can say, the company has a buffer which it can cover its interest liability. Another two important ratios by which the liquidity of a company is judged is current ratio and liquidity ratio. Current ratio should be 2:1. It is not, and liquid ratio should be 1:1. But as I have discussed in my previous lectures also, this is not a hard and fast rule. It depends upon company to company also, because some of the companies which have huge cash reserves, because of they are in the maturity stage and they do not have much you can say project at hand. For example, TCS, Tata Consultancy Services, where the liquidity ratio is almost equal to current ratio, 2:1, because of the high cash reserves of these IT companies, Tata Consultancy, Infosys, for example. And in case of some companies, the cash may be less because of their constant production, constant working capital requirements. So current ratio in that case is maybe less than 2:1 or not. But the general criterion is 2:1 current ratio, liquid ratio 1:1. Then come to the solvency ratio, that is the debt upon equity, debt equity ratio, and the debt should be at least half of the you can say equity of the company. Debt should be at least half of the equity of the company. After that, another thing which the fundamental analysis look into is the cash flow analysis. That is whether the cash flow of the company is good or not. So first of all, it sees that the cash flow from operating activity should be positive, and net cash flow should also be positive. So this is what financial analyst is. Then it also do a company management analysis, that is whether the management is good or not. So it verifies various factors, who are the background check, that is who are the promoters of the company, who are the directors of the company, how many directors are executive directors, how many directors are independent directors, what is the management, whether the management has a management succession plan or not, as in the case of Infosys, whether the salary of the promoters are commensurate with the net profits. Net profit is increasing and salary of promoters is increasing, that is a good thing. But the profit is declining and the salary of promoters is increasing, that is a red flag. And whether the company is continuously declaring dividend or not, and whether the production capacity means sales is increasing not because only of selling price, but it increasing because of sales volume. So these are the factors which indicate the efficiency of the management. So after doing a thorough economic analysis, industry analysis, company analysis, then the fundamental analyst came to the valuation of equity shares. Then comes the valuation of equity shares. In this valuation of equity shares, the present value of future cash flows are, you can say, calculated on the basis of the discounting rate. Present value of future cash flow in the form of dividend is calculated. And in this case, so in valuation equity share, present value is calculated, and present value is basically the you can say present value or intrinsic value. So it is the present value of future cash flows. Present value of future cash flows. So it is present value of future cash flows in the form of dividend, or it may be in the form of earnings, or it may be in the form of free cash flow. So when we go deeper into this chapter, we will this topic, evaluation of equity shares, we will see that the present value of future dividends are also taken, the present value of earnings are also taken, and the present value of free cash flows are also taken. So we will see all this aspect when we go further into this topic. So for your understanding right now, it is present value is calculated after doing all this fundamental analysis, economic, industry, company. And its present value is present value of future cash flows. So let us see future cash flows in the form of dividend. So how will the valuer proceed? It will project the future dividend, and it will estimate a discount rate, and it will then discount the future dividends to arrive at the present value. That is the concept of time value of money, which you are very well aware. So now proceed to the slides. I will just give a brief of the various concepts which will be used in this valuation of equity shares. That is required rate of return, discount rate, and the internal rate of return. Now come to required rate of return. What is the required rate of return? Required rate of return is the minimum rate of return which the uh, okay. The required rate of return is the minimum rate of return that the investor is expected to receive while making an investment in an asset over a specified period of time. So, when an investor is investing in the particular shares of a company, he actually want a minimum return, which should be acceptable to him or her. So that is what the required rate of return is. And this required rate of return is also called the opportunity cost of the cost of capital, because it is the highest level of expected return foregone, which is available elsewhere from the investment of similar risk. So you are all aware of this concept, opportunity cost, cost of capital. Now come to the discount rate. As we have seen in the calculation of present value of equity shares, that is, the future dividends are first of all estimated and they are discounted at a discount rate. So this discount rate is used to calculate the present value of future cash flows. And discount rate depends on the risk-free rate and risk premium of an investment. So actually, each cash flow stream comes from different assets which can be discounted at a different discount rate. I will go through a brief example and I will elaborate it further, this required rate of return and discount rate. So what happens is that most of the time this required rate of return, what is the required rate of return? Required rate of return is the minimum return which an investor expects on his investment. So generally this minimum required rate of return is used as the discount rate at which the present as which the future cash flows are discounted to arrive as the present value. Now, just minimum required rate of return. And it is sometimes used as the discount rate also. I would say not all the time, but it's generally used as the discount rate. And this discount rate is the KE, or the KE is cost of equity capital. Cost of equity capital. This is the cost on the part of the company because company is declaring dividend. So when the company is issuing shares, dividend is a cost, but it is a return on the part of the investor. So that is why this minimum required rate of return and the cost of equity capital is used interchangeably. And it is used at the discount rate also because it is the minimum acceptable rate of return which the investor accept on his investments. This cost of equity capital can be calculated in two different ways. One of the ways through Gordon's model. One of the ways through Gordon's model in which K is equal to D1 upon P0 plus G. D1 upon P0 plus G. So this D1, what is this D1? D1 is thank you. D1 is dividend at the end of first year. D1 is dividend at the end of first year. G is growth rate. G is growth rate. And P0 is current market price. Current market price. And in this method, by way, P0 is also calculated, can be calculated, that is intrinsic value by Gordon's model, D1 upon Ke minus G. By this formula, it can be deduced. K is equal to P1, D1 upon P0 plus G, or P0, we can calculate P0 by this formula also. P0 is equal to D1 upon K minus G. So in this case, P0, it is actually the present value. We have to calculate the present value. Present value of what? The present value of the equity shares, price of equity shares. So P0 is equal to D1. D1 is dividend at the end of the first year. K is cost of equity and G is the growth rate. So this is the Gordon's model. But Gordon's model has certain flaw. The basic flaw is it does not consider the risk, because as you know, while investing in the equity share, there is a risk inherent in it. So another way to calculate this discount rate or the cost of equity is the capital assets pricing model, CAPM model. CAPM model, that is capital asset pricing model. Under the capital asset pricing model, basically the risk is considered. So in this case, expected return is equal to RF plus beta into RM minus RF. So what it is, some of you must have been aware of this. RF is the risk-free rate. And RM is the RF is the return on risk-free rate. You can say risk-free rate return or return on risk-free rate. RM is the market return. Now beta, this sign shows beta. What is beta denotes? Beta signifies volatility. It signifies volatility. What it tells, what beta tells? Beta tells that how the price of a particular stock moves in comparison to the market index. How the stock price, particular stock price moves in comparison to the index, whether it is BSE, Bombay Stock Exchange, or it is NSE. National Stock Exchange. So it tells that how a stock moves in comparison to the market index. For example, the market, the BSE, is giving 10% return. And the stock is also given 10% return. So in this case, the beta will be 1. But how about when beta is 1.2? What it means? Beta 1.2. Beta 1.2 means that the stock moves high in comparison to the index. So, for example, the price of a particular stock is say 100. It moves from 100 to 110. Okay. But Sensex has moved higher in percentages. So you can understand by this simply that the Sensex moves up by 10%. And the stock, you take any company, for example, stock of ABC Limited, moves at 12%. तो सेंसेक्स अगर 10% बढ़ता है तो एबीसी लिमिटेड की जो स्टॉक प्राइसेस है वो 12% बढ़ती है, तो दैट इज गुड. बट इट हैज अ डाउन साइड ऑल्सो. अगर क्या होगा, सेंसेक्स अगर 10% गिरता है, अगर 10% कम होता है, तो देन स्टॉक भी 12% कम होगा, जो कि इन्वेस्टर्स के लिए वो लॉस ज्यादा होगा. तो इट शोज वॉलेटिलिटी, मतलब स्टॉक जितना ऊपर बढ़ रहा है या नीचे, फॉर एग्जांपल इंडेक्स जितना ऊपर बढ़ रहा है या नीचे बढ़ रहा है, उस कंपैरिजन में स्टॉक ज्यादा मूव कर रहा है. तो बीटा इज बेसिकली अ मेजर ऑफ वॉलेटिलिटी. So I will stop here. When I explain equity risk premium, I will take this brief question capital asset pricing model also. On this, it will be clear. For your understanding, the discount rate can be by way of Gordon's model as well as CPAM model, CAPM model, such as capital asset pricing model. Under Gordon's model, it is calculated by D1 upon KE minus Gs. But by this formula, the risk is not considered. So in case of those companies which are risky, in which there is more volatility, it is better to use the capital asset pricing model while valuing the equity shares. So in this case, a simple formula is there in case of CAPM model, RF plus beta into RM minus RM. That is risk return on risk-free rate plus beta multiplied by return on market minus risk-free rate. Now let's move forward. Now come to internal rate of return. What is the internal rate of return? Internal rate of return is the return which equates is the rate at which the present value of cash inflows are equal to present value of cash outflows, as you know. And it is also the discount rate which equates the present value of future cash flows of a security to its market price. And IRR is also viewed as the average annual rate of return that investors earn over their investment time period, assuming that the cash flows are reinvested at the IRR. As you know, you have already studied this internal rate of return, so I will not go deep into it. Let us proceed further. Now come to this equity risk premium. It is a very important concept in this valuation of equity share, especially when you are considering calculating the discount rate or the cost of equity capital on the basis of CAPM model. I think I will do a small practical problem in this case so that it is more clear to you. Equity risk premium. So as I have just explained, the CAPM model, what is the formula of the CAPM model? Under CAPM model, the expected return or the return which are minimum required rate of return, which is used as the discount rate to discount the present value of future cash flows. So it is calculated as RF plus beta into RM minus RF, or risk-free rate plus beta into RM minus RF. RF is the risk-free rate. RM is the market return. For example, what return the index, that is Sensex or National Stock Exchange or the BSE, that is Bombay Stock Exchange, is generating. And beta shows the volatility, that is how much the stock is moving in comparison to the index, that is NSE or BSE. Now this RM minus RF, this portion RM minus RF is called the market risk premium. Is called the market risk premium. It's called the market risk premium. And this portion, beta into RM minus RF, this portion is called the equity risk premium. Okay. Now let us take a brief example. For example, dividend is 1.5, growth rate is 7%, signifying by G. RF is 9%. RM is 13%. Beta is 1.5. And you have to calculate the cost of equity. You have to calculate the cost of equity or the minimum required rate of return. So expected return or minimum required rate of return, KE, is equal to, just apply the formula, RF plus beta into RM minus RF. So it is 9% plus, calculate cost of equity and present value also. Both have to be calculated. So this is 9% plus beta is 1.5 and it is 13% is RM minus RF is 9%. So let us calculate it. So this is 9% plus 1.5 into 13 minus 9 is to 4% is equal to 9% plus 1.5 into 4, 6% is equal to 15%. So cost of equity capital is 15%. And in this, what is the market risk premium and what is equity risk premium? Can you tell? So this figure, 13 minus 4, 4%. This 4% is the market risk premium, means how much market is return is more than the risk-free rate. Now, are you able to understand what risk premium is? Means, we are explaining this term equity risk premium, market risk premium. Risk premium means the investing in equity shares requires certain amount of risk. So the equity investors want more return from it. So that is what premium is. Means whatever risk it is taking, it wants certain premium, certain incentive on it. That is what risk premium is. So market risk premium means whatever market has certain risk. So obviously, if there is more risk, there is more return. Therefore, market return is 13% and risk-free rate. Risk-free rate, you can say where there is no risk. You can say tax-free government bonds. So let us say tax-free government bonds are generating 9% and market return. For example, NSE is generating 13%, giving 13% return. So 13 minus 4, that is 4%. 4% is the market risk premium. Means that if one is investing in the market, investing in the, you can say Nifty or Sensex, it is at least expecting a return, minimum return of more than 4%. It is actually expecting 4%. So कोई भी अगर रिस्क फ्री बॉन्ड में इन्वेस्ट करता है तो उसको 9% मिलेंगे, वो सेफ एंड सिक्योर रहना चाहता है. पर कोई अगर थोड़ा ज्यादा रिस्क लेता है, अगर मार्केट में इन्वेस्ट करता है तो थोड़ा रिटर्न ज्यादा चाहता है. तो कितना रिटर्न वो ज्यादा चाह रहा है? वो 4% ज्यादा चाह रहा है. तो मार्केट जो है 4% रिटर्न वो ज्यादा चाहेगा. नाउ कम टू इक्विटी रिस्क प्रीमियम. अगर कोई इक्विटी शेयर्स में इन्वेस्ट करता है तो कितना रिटर्न ज्यादा चाहेगा? वो एटलीस्ट उसमें 6% रिटर्न उसमें ज्यादा चाहेगा. So this portion 1.5 into 4%, 6% is the equity risk premium. So market risk premium is market risk premium is 4% and equity risk premium is equity risk premium is 6%. Okay, so I hope this concept is clear to you, this equity risk premium, and how the, you can say, cost of equity is calculated by both these methods, Gordon's model as well as CAPM model. In the Gordon's model, risk is not considered, while in case of CAPM model, the risk is considered because beta is included. So beta actually, you can say, signifies volatility or signifies risk. So present value can be calculated by this method also, because I will not calculate it now, because I will take, when I take practical problems, I will delve into it further. So let us here concentrate on this Cost of equity only. Okay, so let us get back to the PPTs again. Now required return on equity. So required return of equity can be easily calculated with the help of capital asset pricing model, as we have seen. The main insight of the capital asset pricing model is that the investors evaluate the risk of an asset in terms of assets contribution to the systematic risk. So what are systematic risks? Which cannot be reduced by diversification of the total portfolio. सो मेन जो एम्फेसिस होता है वो सीएपीएम मॉडल का होता है कि इन्वेस्टर्स जो है रिस्क को इवेल्युएट करता है. रिस्क को कैसे इवेल्युएट करता है? वो बीटा उसको सिग्निफिकेशन देता है, क्योंकि जो इन्वेस्टर को अनसिस्टमैटिक रिस्क से मतलब नहीं है, क्योंकि अनसिस्टमैटिक रिस्क को पोर्टफोलियो को डाइवर्स करके, मतलब फॉर एग्जांपल किसी एक पर्टिकुलर पोर्टफोलियो हम 10 कंपनी में इन्वेस्ट कर रहे हैं. फॉर एग्जांपल 5 कंपनी में इन्वेस्ट कर रहे हैं, टीसीएस, इन्फोसिस, you can say ITC, Hindustan Unilever Limited, and Maruti Suzuki. For example, these 5 companies, as an investor, I am investing. So these 5 companies consist of a portfolio. These 5 companies will consist of a portfolio. So if the portfolio increases, then the risk is obviously reduced. The risk is obviously reduced. Okay, if I am investing in the shares of only one company, my risk will be more. How? Because if the company does not do well, share prices come down, then I will be at a loss. Instead of investing in 5 companies, I am investing in one company. I am investing in 5 companies. So now is my risk is lower or is my risk is higher? The answer is obvious. My risk will be lower, because even if one of the companies out of 5 companies, 2 have failed, means failed to score profit, and their share prices come down. But out of 5, 3 companies market shares increases. So overall, I have pocketed profit. So overall, there is an overall profit, because 3 companies have done well. So that is the advantage of portfolio, means increasing your shares. So unsystematic risk, these are unsystematic risks, can be countered by increasing the portfolio. मीन्स 5 से 7 कर दिया, 10 कर दिया, पोर्टफोलियो को इंक्रीज करके हम रिस्क को कम कर सकते हैं. और जो सिस्टमैटिक रिस्क होता है, यहाँ जो टर्म यूज हुआ है सिस्टमैटिक रिस्क, उसको पोर्टफोलियो डाइवर्सिफिकेशन से हम किसी कंपनी के शेयर्स कम ज्यादा बढ़ा के, कंपनी 10 से 15 कर दिया, 15 से 20 कर दिया, उससे सिस्टमैटिक रिस्क जो है वो कम नहीं होता है. सिस्टमैटिक रिस्क डाइवर्सिफिकेशन से कम नहीं कर सकते. फॉर एग्जांपल जो है एक एग्जाम्पल इसका ले सकते हैं. फॉर एग्जाम्पल इंटरेस्ट रेट. फॉर एग्जाम्पल इंटरेस्ट रेट जो है आरबीआई ने बढ़ा दिए. फॉर एग्जाम्पल 6% था, 6% से 6.5% कर दिया. तो इन्वेस्टर ने जब ये बढ़ा दिए, तो इसका जब रेट ऑफ इंटरेस्ट इंक्रीज हो जाता है, रेट ऑफ इंटरेस्ट, तो इसका भी इफेक्ट पड़ सकता है. ये इन्वेस्टर के कंट्रोल में नहीं है कि इंटरेस्ट रेट को कम करना या इंटरेस्ट रेट को बढ़ाना, ये गवर्नमेंट का डिसीजन है. तो इस तरह के जो रिस्क होता है, जैसे इंटरेस्ट रेट एकदम से बढ़ गया, या गवर्नमेंट का ये डिसीजन हुआ कि यस वो पर्टिकुलर किसी यूरोपियन कंपनी से या किसी पर्टिकुलर यूरोपियन कंट्री से वो डील नहीं करेगी. तो इस तरह के जो डिसीजंस होते हैं वो प्योरली पॉलिटिकल डिसीजन होते हैं, वो सिस्टमैटिक रिस्क होते हैं, जिसको कि इन्वेस्टर को दूर नहीं कर सकता. तो बीटा जो है बेसिकली इन सिस्टमैटिक रिस्क को कवर करता है कि वो कितना सिस्टमैटिक रिस्क होगा अगर हम किसी पर्टिकुलर कंपनी के शेयर्स में इन्वेस्ट करेंगे. Now come to third point. CAPM model provides a relatively objective procedure for required return estimation. It has widely used in valuation. तो एक ऑब्जेक्टिव प्रोसीजर बताता है रिटर्न एस्टिमेशन का, कैसे रिटर्न को एस्टिमेट कर सकते हैं, एंड इट हैज बीन वाइडली यूज्ड इन वैल्यूएशन ऑल्सो. Now come to discount rate selection. What discount rate should be selected? Cash flows are discounted at a suitable rate to arrive at the present value of cash flows, which will be available in the future. When cash flows to be available to equity shareholders are discounted, the required rate of return is an appropriate discount rate. Further, when cash flows are available to meet the claims of all the company's stakeholders, then the cost of capital is the appropriate discount rate. So, when cash flows, simple, when cash flows are available to equity shareholders, required rate of return, that is cost of equity capital, is the discount rate. When the cash flows are available to all the company stakeholders, then cost of capital is used. In under cost of capital, then cost of equity and cost of debt, both is included. Here in cost of capital, both cost of equity, as you know, and cost of debt, both are included. So, in case of some of the, if a company is investing in a particular project and its funds consist of both the equity as well as debt, then the better way to use is to cost of capital or the weighted cost of capital, which includes both the cost of equity and cost of debt. But when the cash flows are available to the equity shareholders are discounted, then the investors generally use the required rate of return and cost of equity capital. And what is the cash flow to the equity shareholders? The cash flow to the equity shareholder will be, you can say, dividend, or it can be, you can say, the estimated as earnings also, or free cash flow. Free cash flow is concept को हम लोग बाद में इसको लास्ट में समझेंगे लोग लेटर. तब ये चीज जो कॉस्ट ऑफ इक्विटी कैपिटल का कॉन्सेप्ट जो है वैल्यूएशन इक्विटी शेयर्स का और क्लियर होगा आपको. Now, concept of nominal cash flow and real cash flow. Nominal cash flow is the amount of future revenues the company expects to receive and expenses it expects to pay out without any adjustment for inflation. So, nominal cash flow is the cash flow without any, in which there is no adjustment for inflation. It includes inflation. On the other hand, real cash flow shows a company's cash flow with adjustment for inflation. Means this is the cash flow which arrives after adjusting the inflation. So real cash flow is the cash flow which arrives after adjusting the inflation. Now, discount rate selection. Which discount rates should be used? If there is nominal cash flow, nominal rate of discount is used. If there is real cash flow, real rate of discount is used. So, but while valuing equity shares, and in this topic, we are focusing on only the valuation of equity shares. So, only nominal cash flows are considered. Therefore, only nominal discount is considered. Since nominal cash flows are considered, nominal discount is considered. And what is the reason for it? Reason is that the tax applying to corporate earnings is generally stated in nominal terms. The tax applying to corporate earnings is generally stated in nominal terms. Therefore, using nominal cash flow in equity valuation is the right approach because it reflects taxes accurately. So after this brief introduction, we are now coming to valuation of equity shares. There are three different approaches: dividend discount, dividend-based model, earning-based model, and the cash flow-based model. We will take one by one. Now, first of all, begin with dividend-based model. The valuation of equity shares on dividend-based model have following assumptions. That is, dividends are paid annually over an infinite period of time. And dividends are paid annually over an infinite period of time, and payment of first dividend shall occur at the end of the first year. Payment of dividend shall occur at the end of the first year. And sale of equity shares occur at the end of the at the end of the year. Now, I am asking you a simple question, that why the investors want to invest in equity shares? They want to invest in equity shares because of they want higher returns in the form of dividends and capital gain, हायर सेल प्राइसेस. मतलब अभी किसी इन्वेस्टर ने अगर 100 रुपीज में कोई शेयर्स खरीदता है तो वही सोचेगा कि वो अगर वो बेचेगा तो 100 से ऊपर प्राइस मिले, या उसको कंटिन्यूअस उस पे जो है डिविडेंड मिले. तो इस चीज को ध्यान में रखते हुए यू कैन से डिविडेंड मॉडल को वो किया गया है, बनाया गया है. एंड देयर आर सर्टेन अजम्पशंस कि डिविडेंड जो पे किया जाएगा वो इनफाइनाइटली मींस लॉन्ग टर्म तक उसको पे किया जाएगा. इट विल बी पेड ओवर अ लॉन्ग पीरियड ऑफ टाइम, एंड the first dividend will be paid not at the beginning of the year, it will be paid at the end of the year, and sale of equity shares shall also occur at the end of the year. Let us take so P0, P0 defines the present value of equity shares or intrinsic value of equity shares. It will be D0 into 1 plus G upon 1 plus K. So what is this D0 into 1 plus G? This is actually D1, dividend at the end of the first year. The first assumption is dividend should be received at the end of the first year. So D0 means dividend, current dividend. D0 is current dividend multiplied by the growth rate. So it will be dividend at the end of the first year. And KE is, the discount rate. So dividend which has been received at the end of the first year is discounted by this discount rate KE to arrive at the present value, means the present value of equity shares now. Because as an investor, I am investing in the equity share at the present moment. Plus D0 into 1 plus G square upon 1 plus KE, 2 plus D0 into 1 plus G cube upon 1 plus KE to the power 3. And so on. It may continue. So this D0 into 1 plus G2, this is actually D2, that is dividend received at the end of the second year. And this one is dividend received at the end of the third year. So dividend received at the end of the second year is discounted by using this discounted KE to arrive at this present value. Dividend received at the end of the third year, D3, is discounted to arrive at the present value. So this is the simple dividend-based model. And in this case, a shortcut method is used. Why a shortcut method is used? Because if the dividend has been received for 10 years, so it will be very cumbersome to calculate by this formula for every 10 years. So shortcut formula is P0 is equal to D1 upon KE minus G. D1 upon KE minus G. And this is also the Gordon's formula. I will take some more problems on this Gordon's method. Okay. So this is the shortcut one, P0 into D1. But this formula is used when it is assumed that the dividend will be received for an infinite period or dividend will be received for a long time to come. Okay. And dividend based model, let us see this slide. The value of any asset depends on the discounted value of cash streams expected from the same asset. Accordingly, the value of equity shares can be determined on the basis of stream of dividend expected at required rate of return or opportunity cost. So this is the same, means this explanation is same, that how the valuation is done. First of all, our future dividend is estimated. Then this estimated future dividend is discounted by a discount rate to arrive at the present value. Simple. Now, this valuation of equity shares can be determined based on the holding period as follows. A valuation based holding period of 1 year. We will take the first position that if the equity shares are held for 1 year, अगर equity shares को आप as an investor 1 साल के लिए होल्ड करते हैं, 1 साल के लिए अपने पास रखते हैं, तो अगर आप उसको 1 साल के लिए रखेंगे तो ऑब्वियसली एट द एंड ऑफ द ईयर आप उसको बेचेंगे. तो फॉर्मूला क्या है इसका? P0 is equal to D1 upon 1 plus KE1 plus P1 divided by 1 plus KE1. This 1 plus KE1 because it is D1 means dividend at the end of the first year and it is discounted by the present value factor of the first year. And P1 is the price because the investor is holding this for 1 year and after the end of the first year, it wants to sell it. So let us take a brief example, I think, on this. Let us take dividend after 1 year is 5 and price at the end of 1 year is 20 and required rate of return, that is discount rate, is 20%. So 20% is the, you can say, discount rate K. Dividend is 5 and price is 20. Dividend is 5 at the end of the first year. Price is 20 at the end of the first year and 20% is the discount rate. So we will put the values into the formula. P0 is equal to D1 means dividend at the end of the first year this is 5 upon 1 plus KE discount rate 1 plus 0.20 plus price 20 upon 1 plus apply the discount rate. Let us calculate it. So it is coming at 20.83. The answer is 20.83. So this is an example I have given if the shares are held for 1 year. I hope it is clear to you. Now, if the shares are held for more than 1 year, first aspect I have taken is valuation based holding period of 1 year. अगर shares को 1 साल के लिए hold करते हैं. Second aspect is if the shares are held for more than 1 year, that is multi-holding period. So there are 3 aspects: zero growth rate, constant growth rate, and the variable growth rate. Zero growth rate means the dividend is fixed. मतलब अगर कंपनी ₹10 डिविडेंड डिक्लेयर करती है तो हर साल 10 रहेंगे। कांस्टेंट ग्रोथ रेट मींस अगर कंपनी 10% इंक्रीज हर साल दे रही है तो दैट इज अ कांस्टेंट ग्रोथ रेट। क्योंकि 10% कांस्टेंट है और वेरिएबल है कि कंपनी एक साल 10% दे रही है, फिर 5% दे रही है, फिर 2% दे रही है, तो वेरिएबल ग्रोथ रेट। तो अगर कि कोई इन्वेस्टर अगर एक साल से ऊपर के लिए होल्ड करता है तो देन देयर आर थ्री एस्पेक्ट टू इट। वो कंपनी की पॉलिसी के ऊपर होता है कि वेदर द कंपनी इज फॉलोइंग अ जीरो ग्रोथ पॉलिसी, मींस क्या वो फिक्स डिविडेंड दे रही है या कंपनी जो है वो कांस्टेंट डिविडेंड ग्रोथ पॉलिसी है, मतलब वो हर साल 10% या फिर 15%, 20% डिविडेंड दे रही है जो कि फिक्स है, या वो हर साल डिविडेंड रेट जो है वो चेंज कर रही है। So that way, and there are the calculation in these cases are different in different cases. Now we will see the first aspect, that is zero growth rate dividend, means the dividend remains same over the years infinitely. So value of equity share can be found by this formula: P0 is equal to D upon KE. Let us take a brief example. Let us suppose dividend is 20%. Face value of shares is 100 and the required rate of return KE is 15%. So P0 is equal to, let us put the values into the formula. P0 is equal to D. Dividend will be is always calculated on the face value. So 20% of 100, this is ₹20, divided by KE is 0.15. So let us calculate it. 20 upon. So it is coming to 133.33. 133.33. So this is the value of equity shares in case of a zero growth rate model. I hope this example is clear to you. Now proceed further to constant growth rate. In constant growth rate, actually the zero growth rate is very impractical to say, because it rarely happens that the companies declare a fixed dividend every year. But the constant growth rate is also impractical, because in practical, if you see that it is very rare that the companies declare dividend at a fixed rate. मीन्स ऐसा ज्यादातर प्रैक्टिकल सिचुएशन में नहीं होता कि कंपनी हर साल एक ही रेट ऑफ डिविडेंड इंक्रीज कर रही है, एक ही रेट से। अगर 5% इस साल इंक्रीज किया, ऐसा जरूरी नहीं है कि हर साल 5%, 5%, 5% देती रहे, वो डिफर होता है। तो दिस इज ऑल्सो एन unrealistic assumption in Gordon's model. But if this assumption is taken, if a company is following a constant growth rate, then how it is calculated, we will see. It is calculated by the following formula: P0 is equal to D1 upon K minus G. ये formula हमने पहले भी यूज किया था वैल्यूएशन में, और D0 into 1 plus G upon K minus G. Let us understand this again. What is P0? P0 is the present value of equity shares or the intrinsic value. What is D1? D1 is the dividend at the end of year 1. Okay. What is G? G is the growth rate. What is K? K is the cost of equity. Okay. So let us take an example in this case, constant growth rate. Constant growth rate. तो constant growth rate का जो basically the formula is we are following what is the formula? This is constant growth rate. The formula is P0 is equal to D1 upon Ke minus G or D0 into 1 plus G upon Ke minus G. So this is basically the shortcut formula. This is it can be calculated by this portion. See, I have already explained it that it can be calculated by this method also. That is P0 is equal to D0 into 1 plus G. That is current dividend multiplied by the growth rate. So it will come to D1. So D2 plus D3. So this way it can be calculated. And this formula, D1 upon Ke minus G, is the shortcut formula. And this formula is used when the dividend are expected to be given continuously for an infinite period of time or a very long period to come. Let us take an example. Let us say dividend is 15%. Face value is rupees 100. Growth rate is 5%. And KE, that is cost of equity, is 20%. Okay. Now let us solve this problem by this method, Gordon's constant growth rate method. So it will be P0, formula P0 is equal to D1 upon K minus G is equal to D1. So what is the current dividend? Current dividend face value 100 given, dividend 15% means 15% of 100, it will be rupees 15 multiplied by growth rate, because growth rate is 5%. So we will multiply the current dividend by the growth rate in order to arrive at the dividend at the end of the first year. So D1 is dividend at the end of the first year upon KE minus G, discount rate KE 0.20 minus K minus G. G is the growth rate, 0.05. Let us calculate it. It's 15.75 divided by 0.2 minus 0.05 is coming to 0.5. Is coming to 105. So this 105 is the present value of equity shares, or this is the intrinsic value. Okay, fine. Shall we proceed now? Now come to variable growth rate. Variable growth rate dividend is, you can say more or less, it is more practical. It is more practical. Before proceeding to this variable growth rate, one or two things which I want to mention here. Let us take it, and then I will come to variable growth rate. Some of the assumption, very good assumption, a conclusion in case of constant growth rate model is this growth rate is constant. The G is constant, means growth rate is here. This practical problem which I have taken, the growth rate is 5%, G is 5%, and it will continue to be 5% for an infinite period of time. That is why constant growth rate model. So G is constant. Second is G is less than the required rate of return of investor. This is a very, very important assumption or of Gordon's model. That is, cost of capital is greater than the growth rate. Means growth rate is less than the cost of capital. Cost of equity capital will always be greater than the growth rate in case of Gordon's model. In practical situation, growth rate may sometimes be higher, but in most of the cases, the cost of equity capital will always be higher than the growth rate. And the final assumption is that G is the subjective estimate of the investors. G is actually the estimate of the investors. He estimates that. How he estimates? On the basis of the past experience, how the company is paying. On this basis, the estimated means that the company will now pay at 5% or 10% or 15%, whatever it is, for a long time to come, for an infinite period of time. So these are the basic assumptions of Gordon's model, that G is constant, growth rate is constant, and the cost of equity capital is always greater than the growth rate, or growth rate will always be less than the cost of equity capital. That is, K will always be greater than G. This is a very important part of the Gordon's model. You have to remember this. And growth rate is the subjective estimate of the investor. Now come to the constant growth rate model. Variable growth rate model. Constant growth model is done. Now come to variable growth rate in dividend. So just go through the slide, and then I will take a practical problem in this, the variable growth rate. What happens in variable growth rate? It generally considers that the growth companies, the initial period of growth is very high in case of most of the companies. So they generally declare more dividends. So growth rate is high. And after some time, when the company reaches the maturity stage, the growth rate generally, you can say, fixed at a certain rate. So it is generally assumed that in the initial years, the growth rate is high, and after some time, the growth rate is less. So just go through the slide first, that just like constant dividend assumption, the constant growth assumption also appears to be unrealistic. Accordingly, the valuation of equity shares can be done on the basis of variable growth rate in dividend. So in practical scenarios, most of the time, this variable growth rate in dividend is followed. It should, however, be noted that though we can assume multiple growth rates, but when one growth rate shall be assumed to be for infinity only, then only we can find the value of equity share. Because Gordon's basic concept is that the dividend should be at a certain rate for an infinite period of time. So at certain level, we have to, as an investor, take a decision that dividend will be growing at a growth rate will be at a certain percentage only. For example, in the initial years, the company is paying dividend at the rate of 15%. After reaching a maturity stage, it then start declaring it at 10%. After some years, it starts to declare dividend at 5%. And at this stage, the investor assumes that the company will declare dividend at 5% from now on for a long period of time, or till infinity. So that is the basic concept of the dividend-based model. And in this case, we will take the two-stage dividend discount model. In two-stage dividend discount model, it is generally assumed, as I have discussed, that during the first initial years, there is supernormal growth. So growth rate will be high, and after some time, when the company reaches a maturity state, the normal growth rate will prevail for an infinite period of time. For example, अगर कंपनी इनिशियल ईयर्स में कंपनी का ग्रोथ बहुत ज्यादा है, तो 15% पे रखा गया. आफ्टर सम ईयर्स, 4-5 साल बाद, जब मैच्योरिटी स्टेज आई थोड़ी सी, तो उसको फॉर एग्जांपल 10% पे रखा गया। तो ये जो 10% है वो लॉन्ग पीरियड ऑफ टाइम, ये 10% जो है इनफाइनाइट पीरियड तक वो कंटिन्यू रहेगा। तो जो गॉर्डन मेथड का यही एजम्पशन है कि एक पर्टिकुलर स्टेज पे इन्वेस्टर्स को ये डिसाइड करना पड़ेगा कि किस रेट पे वो, किस ग्रोथ रेट पे डिविडेंड जो है वो इनफाइनाइट पीरियड तक रिसीव होगा। सो 15% जो है पहले 5 साल के लिए 15% रखा गया जब कंपनी ग्रोथ रेट बहुत हाई थी। आफ्टर 5 इयर्स वो 10% रखा गया कि अब वो 10% की रेट से, ग्रोथ रेट से कंपनी जो है वो बढ़ेगी फॉर अ infinite period of time. The formula is this. P0 is equal to, just go through the formula, and I will take an example, and it can be solved without using the formula. And if you solve it without using the formula, it will be more clear to you. So I will first of all try to explain it in a simple language so that you can understand. And then I will solve this example with the help of the formula also. Two-stage dividend discount model. Let us take an example and then I will explain it to you. Let us take dividend at ₹2. Growth rate, let us take the growth rate, growth rate for first 3 years at, you can say 10%. Okay. Then it will be taken at 5% annually. For your clarity, I am writing in the bracket till infinity. Sorry, I am writing it till infinity. Till infinity. And discount rate is 15%. So what is the question? Dividend is ₹2. Growth rate for first 3 years is 10%. So this is the supernatural, extraordinary growth rate for this company. Then after some years, after 3 years, when it reaches the maturity, it is taken at 5%. It is assumed that it will grow at 5% annually till infinity for a long time to come. Cost of capital is, equity capital is given in the question, 15%. So let us use this two-stage dividend discount model and try to solve this problem. We will make a column first, okay? So end of year, this is dividend. This is present value factor at the rate of 15%. And this is the PV, that is present value. First year, second year, and third year. Or I can write the year here. First year, second year, and third year. So dividend, current dividend right now, the present moment, the dividend is ₹2. And what is the growth rate? 10%. So what will be the dividend at the end of the first year? It will be 2 into 110% or 2 into 1.1. So it will be 2 into 1.1 will be 2.2. Okay. What is the current dividend? 2. And what will be the dividend at the end of the first year? Current dividend multiplied by the growth rate, because it is growing at 10%. So 2 into 110%, or 2 into 1.1, it would be 2.2. So this is 2.2 is the dividend at the end of this. This 2.2 is the dividend at the end of the first year. So this 2.2 is again multiplied by 1 in 1.1 or 110% to arrive at the dividend at the end of second year. So it will be 2.2 into 1.1 will 2.42. Okay. Now this 2.42 is dividend at the end of the second year. So what will be the dividend at the end of the third year? It will be dividend at the end of the second year. That is 2.42 into 1.1, 110%. 2.42 into 1.1 is 2.662. Now, what is the present value factor for 15%? Let us calculate it. Is 0.869, or you can say 870. 0.756 658. 658. This is the present value factor. Now, in order to calculate the present value, you have to multiply. You have to use the discount rate to arrive at the present value. So dividend at the end of the first year is 2.2. You will apply the discount rate to arrive at what will the present value now? What is the value of the dividend now? So dividend at the end of the first year multiplied by the PV factor, the discount rate. 2.2 multiplied by 0.87, coming to 1.914. Then again in the same way, 2.42 into 0.756, the PV factor. So 1.830, and then third year 2.662 multiplied by 0.658. It is 1.752. So now add these three figures. 1.1914 plus 1.830 plus 1.752. 5.496. So what is this? What is this value? It is the present value at 10% growth rate. Is that 10% growth rate? But our solution problem does not comes to end here. You have to calculate the present value at 5% also, because from fourth year onwards, the growth rate changes to 5%. Now, P3 is equal to, just pay attention here, D3 1 plus G upon K minus G. So, you're able to understand what this is, why I have written P3. P3, what P3 indicates? P3 indicates that it is actually the present value at the end of third year. Okay. Or present value at the beginning of fourth year. That is why P3. beginning, this is the value, P3 is present value at the end of the third year, present value at the beginning of the fourth year. Why beginning of the fourth year? Because up to third year we have already calculated it. And why D3 into 1 plus G? This is D3 is dividend at the end of the third year multiplied by the growth rate. So it will be dividend at the end of the fourth year. So dividend at the fourth year will be discounted to arrive at the dividend at the beginning of the fourth year. So this is basically the dividend at the end of the fourth year. This can also be written as D4 upon K minus G. So either it can be written as D3 into 1 plus G, or it can also be written as D4, dividend at the end of the fourth year. So how this dividend at the fourth year will be calculated? Apply the value into the formula, put the value into the formula. D3 we have already calculated. See, 2.662. So 2.662 multiplied by the growth rate. Now you have to pay attention. Growth rate is now not 10%, it is 5%. So 0.05 divided by Ke minus or Ke minus G. Ke is given in the question. Ke is 15%. So it is 0.15 minus G. What is the growth rate? Growth rate is now 5%. Let us solve it. So it will be 2.7951 divided by 0.1. So it is coming to 27.95. So this is basically the present value at the end of the third year. But is it the problem solved here? The answer is no, because it is the present value at the beginning of the fourth year. This is the present value at the beginning of the fourth year. We have to calculate the present value now. So P0 of this figure, 27.95, has to be calculated. So P0 in this case, P0 at 5% growth rate is equal to 27.95. And to apply it, to calculate at P0, we will apply the PV factor for the third year. PV factor, this is 0.658. We will apply this PV value. It is coming to 18.39. So what will be the final PV value? It is P0 now, P0 at both 5% growth rate and 10% growth rate. Is equal to, sorry, is equal to 5% growth rate, it is 18.39, we have already calculated, plus the supernatural growth rate, we have calculated 5 point, this figure, 5.496. 5.496. Coming to 23.89. Coming to 23.89 approximately. So this is the way the two-stage discount model, the calculation has to be done. So how do we proceed? Let us see the simple example. Dividend was 2. Growth rate for first 3 years, it is dividend for first 3 years, it is 10%. Then it will take in at 5% annually. And then KE is 15%. So first of all, we calculated the dividend for the first 3 years. So 2 is the current dividend. 2 is the current dividend. We multiplied by the growth rate, which is 10%. So into 1.1. So final figure arrived at is 2.2, which is the dividend at the end of first year. We multiplied it by the PV factor to arrive at the 1.194. So this is the present value. This 1.194 is the present value of this 2.2 dividend, which is declared at the end of the first year. In the same way, the present value of all the 3 years has been calculated and added. So present value of 10% growth rate is 5.496. Then the present value at the end of the third year or the beginning of the fourth year has to be calculated, because from the fourth year the growth rate changes. That is why. And from the fourth year onwards, it is estimated that 5% growth rate will continue till infinity. Therefore, this formula d1 upon ke minus g is applied. In this case, it will be P3. Why P3? Because we are now calculating present value at the end of the third year or beginning of the fourth year. That is why it is P3. P3 is equal to D3 into 1 plus G upon K minus G. D3 is dividend at the end of the third year. If we multiply by the growth rate, it will come to D4. So we can D3 into 1 plus G, we can also write it as D4 also. We can also write it as D4 also. We can also write it as D4 also, D4 upon K minus G. So we applied the formula, and beginning of the fourth year, the value arrived at is 27.95. But we have to calculate the present value now. So we multiply this figure 27.95 by the PV factor for the third year, which is 2.662. So 27.95 multiplied by 0.658, it is coming to 18.39. So 18.39 is the present value at 5% growth rate. So now we add the present value at both 5% growth rate and 10% growth rate. That is 18.39 plus 5.496, and the final figure is 23.89, which is the answer. We can also calculate it by this dividend discount model method also. We will take it also by the formula and just go through it, revise it, and we'll come back after the break, after some time, after 10 minutes or so. So I am taking a brief break of about 10 minutes. Yes, welcome back. I was taking this example on variable growth rate model. As I have said, that it can be calculated by those two methods, by applying the formula and by simple logic. So in order to let you understand this two-stage dividend discount model, I have solved this problem by a simple logic, that how it should be calculated. For the supernatural growth rate, it is calculated differently, and for the constant growth rate, it is calculated differently. This I have explained it also. Now, if we can calculate this problem with the help of a formula also. So let us solve it with the help of a formula. This formula is P0 is equal to D0 into 1 plus G upon 1 plus K D0 into 1 plus G. So it can be calculated by this formula also. This is the first 3 years, D0 into 1 plus G, D0 into 1 plus G square, and D0 into 1 plus G 3. This is for the supernatural growth period, the extraordinary growth period, plus P3 upon 1 plus K. Now, P3 will be calculated by this D0 into 1 plus G, 1 plus G1, 3 multiplied by 1 plus G2. So G1 is basically the supernatural growth period, and G2 is the stable growth period, the normal growth period, upon Ke minus G2, the normal growth rate period. Okay. Okay. Now let us solve it. First of all, calculate this portion, the first portion, the supernatural growth portion. What was the dividend? Dividend was 2. Okay. 2 into 1 plus, what is the growth rate? Growth rate was 1%, 10%. Upon 1 plus KE, K is the discount rate is 0.15. Plus 2 into 1 plus growth rate is square divided by 1 plus let us calculate this portion first. $1.913. Let us calculate this second portion. Calculate the third aspect. 1.3, 1.5, 1.93 plus 2.42 divided by 1.32 is 1.83 plus 2.662 plus 1.52 4. 1.8 is coming to 7.9 now. One second. 1.66 divided by 1.5. So it is coming to actually 1.75. 751. So let us now add it all the figures. 1.913, 1.913 plus 1.833 plus 1.751. So 5 point. This is actually coming to 5.497. 5.497. So this is, we arrive at this first point. This now come to P3. We have to calculate the P3 value, this portion. Now we will arrive at this portion, calculation of this portion. Formula is in front of you, D0 into 1 plus G1 to the power 3, 1 plus G2 upon Ke minus G2. Let us put the value into the formula. E3 is equal to G0 dividend is 2, 1 plus G1. The supernatural growth rate is 10%. Divided by 1 plus second growth rate is 5%. Ke cost of equity capital is given in the question, it is 15%. Growth rate 2, normal growth rate period is 0.05. So here G1 is 10%, that is the extraordinary growth rate period, supernatural profit growth rate period, and G2 is the normal growth rate period, which is 5%. It is arriving at uh, 23.95. This is the second. Portion, second portion. 5.493 as calculated 2 into 1 plus 1.1 1.1 into 2 multiplied by 1.05 equal to 2.31. No? This is 1 plus 1. 1. This is actually 1.5 to the power square. 1.1 into 1.1. 1.1 into 1.331. So this figure 1.331 multiplied by 2 multiplied by 1.05. It is actually coming to 2.795 is divided by 0.01. So it's equal to divided by 0.1 is coming to 27.95. Is coming to 27.95. So by this formula, it can also be calculated. This aspect now have been calculated. This is the figure arrived at is 27.95. Now we apply the formula 27.95 P0 is equal to 27.95 divided by this P3 upon 1 plus KE3. So 1 plus KE is 15% to the power 3. Let's calculate it. 27.95 divided by 1.52. It will be 27.95 divided by 1.52 is coming to 18.39. So this is the first portion and this is the second portion. So the answer, the first portion is, this is the first portion and now this is the second portion. The first portion is 5.497 and the second portion is 18.39. So final P0 value is equal to is equal to 5.497 plus 18.39 is equal to 5.497 plus 18.39 23.887 or you can say 23.89. 23.89 approximately. This is the present value. And this has been arrived by this earlier method also. By this method. $23.89 and if we have when we apply the formula, same answer has come. So in this is the formula. How we proceed? We proceed the first portion, that is this D0 into 1 plus G. then d is to 1 plus g to the power 3. This is the supernatural period. This portion to this portion actually. This is a supernatural period, and after that, this is the terminal value is taken. This P3 portion is also called the terminal value. What is terminal value? Terminal value is the value at the start of a period of a normal growth rate period or the end of the super extraordinary growth period. So terminal value is the value at the start of a normal growth rate period or the end of a super profit period. So first of all, you calculate this portion, and the answer is, for the first portion, it is 5.497, and for the second portion, this is 18.39. So we add both these, the final figure is coming to this. And this formula is given in your study material also, this portion, and you can go through it. This is the simple example. I will give you you can note down the example also. This is the example. This is the example, two-stage growth. You can thus note down this example also, take a snapshot and try to solve it with both these methods. And then I will give a one question assignment also. So this will help you in attending the assignment more clearly. आप उसको assignment को और अच्छे तरीके से कर सकते हैं. तो ये क्वेश्चन आप नोट कर लीजिए. दोनों मेथड जो मैंने बताया उसको कोशिश करना आप. फर्स्ट मेथड मैंने आपको एक्सप्लेन किया और दूसरा मेथड भी मैंने आपको एक्सप्लेन किया. The second method formula is also given in your study material also. Now we shall proceed further. And sometimes this three-stage dividend discount model is also used. So under three-stage, it is generally assumed that a dividend firm is growing at an extraordinary growth rate for some period. For example, for first 3 years, it is growing at about 15%. Then a transition period came that it is, for example, it is declining at 2% for next 3 years. And then there is a stable growth rate. So under three-stage discount model, it can be assumed that for the first 5 years, say, it is growing at 15%. And for the, say, next 3 years, it is declining at, say, 2% every year. So first 5 years, then 3 years, 8 years. So from 9th year onwards, what will the normal growth rate? The normal growth rate will be for 5 years, it is 15%. So for the 6th year, it will be 15 minus 2, 13%. Then for 7th year, it will be 13 minus 2, it will be 11%. And for the 7th year, for the 8th year, it will be 11 minus 2, 9%. 9%. And say for the 9th year, it is stable at 8%. So 8% growth rate से ये नॉर्मल ग्रोथ रेट पीरियड होगा. क्योंकि डिविडेंड डिस्काउंट मॉडल में जैसे हमने देखा कि किसी पर्टिकुलर स्टेज पे हमें एज्यूम करना पड़ेगा कि डिविडेंड जो है इस पर्टिकुलर रेट से इनफाइनाइट पीरियड तक रिसीव होगा. दैट इज द बेसिक assumption of the Gordon's dividend discount model. So इस तरह से होता है, and logic will be the same as used in the case of the two-stage discount model. तो three-stage discount model में भी उसी तरह से कैलकुलेट करेंगे जैसे कि two-stage discount model में कैलकुलेट करते हैं. The method will be the same. The approach will be same. There's an alternative method also is given. Now coming to earning-based model. Under earning-based model is used when the investor is certain that the company is not willing to declare dividend. The company wants to forego dividend, and it wants to utilize its retained earnings in the, you can say, expansion of the company. So earning based model उस सिचुएशन में यूज करते हैं, इन्वेस्टर उस सिचुएशन में यूज करता है प्रेजेंट वैल्यू को कैलकुलेट करने के लिए, जब उसको ये लगता है कि कंपनी जो है वो डिविडेंड जो है फ्रीक्वेंटली डिविडेंड डिक्लेयर नहीं करती है, और वो ज्यादातर अर्निंग्स को रिटेन करके उसको फर्दर इन्वेस्ट करती है. तो गॉर्डन मॉडल ही यूज होता है इसमें, एंड दिस मॉडल इज बेस्ड ऑन फॉलोइंग ब्रॉड assumption, दैट इज रिटर्न ऑन रिटेन अर्निंग्स रिमेन द सेम and retention ratio remains the same. So as per this model, an investor might be willing to forego cash dividend in lieu of higher earnings on retained earnings, ultimately leading to higher growth rate in dividend. Now, earning based model, the formula is EPS 1 into 1 minus B upon KE minus BR, where R is return on retained earnings and B is retention ratio. So this in this formula, R is retention ratio and B is retention ratio, R is return on retained earnings. I will take a brief example on this. I would like to take a brief example on this earning based model. Okay. Let us say the EPS is 10. KE is say 20%. KE is 20%. B is 40%, means company is retaining 40% of its profit. And R is 25%. R is 25%. That is return on retained earnings. So let us apply the formula. Formula is P0 is equal to EPS 1 minus B upon A minus BR is equal to EPS is 10. 1 minus what is the retention ratio? 40%, to 0.40 divided by K is 20% minus B into R. B is retention ratio. B is retention ratio 0.4 into 0.25. Okay. So let us solve it. So it is coming to 6 divided by 0.6 upon, you can say 0.1. 6 upon 0.1. It's coming to 6. So value is coming to 60. Okay. So this is a brief example. We put, and formula is also in front of you. We put the values into the formula. This is the final figure. So by this way, the valuation as per present value of equity share is calculated as per the earning based model. Walter's approach is you can say slightly different in comparison to Gordon's model. That is, the formula is in front of you, and the basic assumption which actually the Walter made is that, and it is made on the view that the market price of a share is the sum of present value of infinite stream of dividend and present value of infinite stream of return from retained earnings. I will repeat. Walter's model is based on the assumption that market price of a share is the sum of present value of infinite stream of dividend plus the present value of infinite stream of return from retained earnings. So, if in Walter's model, if KE, that is cost of equity, is greater than R, that is return on retained earning, then company is assumed to be not a growth oriented company. It means that the company's market value will increase if the company declares more dividend, because return is less on retained earning. Whatever the company is retaining is not able to generate returns. So it is better, company thought it better to declare dividend. So when KE, the cost of capital or minimum required rate of return is greater than the return on retained earnings, then the company declares dividend. Declares so declares dividend, and more dividend will lead to more dividend will declare to higher market price. So K is more dividend declares dividend, and more dividend leads to higher market price. More dividend leads to higher market price. And when the KE is less than R, when KE or cost of equity capital is less than the return on retained earnings, then इसका मतलब क्या हुआ कि return whatever company is retaining and investing in the various project is profitable. So company wants to forego dividends. Company want to forego dividend, and this increases company's market price. And this will increase the company's market price. This leads to high market price. Okay, so this is the basic concept of the Walters approach. अब आते हैं प्राइस अर्निंग रेशियो मल्टीप्लायर अप्रोच. Price earning ratio, the value is very easy to calculate, that is EPS into price earning ratio. And this is one of the most common valuation approach that is followed. Since price earning ratio is based on the ratio of share prices and EPS. This is simple to calculate. Value is EPS into price earning ratio. And value is EPS into market, and price earning ratio is market price per share upon earning per share. So market price is calculated by P into EPS. So in this case, generally the price earning ratio is estimated, and this EPS is also estimated. Also, these two figures are actually estimated. Estimate कैसे किया जाता है? सिमिलर कंपनीज के प्रोडक्ट होते हैं, उसके बेसिस पे पी रेशियो को एस्टिमेट किया जाता है. जो उसके पहले कंपनी के पिछले साल की कुछ पी रेशियो से उसके बेसिस पे पी रेशियो को एस्टिमेट किया जाता है. और ईपीएस को भी जो कंपनी के ईपीएस पिछले 5 साल 10 साल से चले आ रहे हैं, को भी फोकस करके पी रेशियो को कैलकुलेट ईपीएस को कैलकुलेट किया जाता है. तो दोनों एस्टिमेटेड फिगर के बेसिस पे वैल्यू को निकाला जाता है. But this is a very simple approach, and it does not actually give the, you can say, exact figure, because that is why it is generally sometimes it is not, it is ignored also by some of the, you can say, fundamental analysts while valuing the shares. And you can say the PE ratio is high in case of growth-oriented companies. The PE ratio is high in case of growth-oriented companies. What is the reason behind it? Why PE ratio is higher in case of growth-oriented companies? Because the investors see that yes, this is a growth-oriented companies. The company is likely to do well in the future, so they want to invest more in the shares of such companies. That is why demand is more in case of such growth-oriented companies. That is why the PE ratio is more. And PE ratio as such does not tell that whether a company is good or bad. PE ratio only tells whether the company is cheap or whether the company is actually, you can say, expensive. PE ratio as such do not tell that whether the company is good or bad. So it is not a very, you can say, popular method among the fundamental analysts. Now coming to another very important part of this valuation of equity shares, which is cash flow based models. There are actually, in practical situation, most of the companies use free cash flow to arrive at the present value of equity shares. Because ultimately what matters is cash. That is why free cash flow method is the most popular method. And there are two approaches, free cash flow to firm and the free cash flow to equity. Free cash flow to firm and the free cash flow to equity. In free cash flow to firm, the discounting factor is the cost of capital, whereas free cash flow to equity, the discounting factor is the cost of equity is the discounting factor. I will take a brief example to explain this because this concept is very important. This free cash flow to firm and this free cash flow to equity. Free cash flow to firm. CFL. Free cash flow to firm. This is also called as unlevered cash flow. This is also called as unlevered cash flow. Why unlevered cash flow? Because it includes both the debt and equity. Because when a cash flow to the firm includes both equity and debt, that is why it is called a unlevered cash flow. So how it is calculated? Free cash flow to firm. This free cash flow to firm is equal to NOPAT. NOPAT is non-operating profit after tax plus interest factor. We add the interest because this in this profit the interest is adjusted, so we have to add it back. We will add back the depreciation also. जैसे हम कैश फ्लो स्टेटमेंट में कैश फ्लो ऑपरेटिंग एक्टिविटीज निकालते थे उसी तरीके से कैश फ्लो निकालेंगे. जो भी प्रॉफिट एंड लॉस अकाउंट का प्रॉफिट होगा उसमें से इंटरेस्ट को ऐड बैक करेंगे, डिप्रिसिएशन को ऐड बैक करेंगे. इससे हमारा एक जो कैश फ्रॉम ऑपरेटिंग एक्टिविटीज आ जाएगा. देन वी विल हैव टू डिडक्ट द कैपेक्स, दैट इज कैपिटल एक्सपेंडिचर माइनस any change in the working capital, that is any change in the working capital. So free cash flow to firm is non-operating profit after tax plus interest after giving the tax effect, T is tax plus depreciation minus any capital expenditure minus any changes in the working capital. और इसको हम ऐसे भी लिख सकते हैं, कैश फ्लो from operating activities minus capex plus interest minus capex. तो कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज में डिप्रिसिएशन का इफेक्ट है और वर्किंग कैपिटल का भी इफेक्ट है, इसीलिए इसमें वो नहीं लिया गया है. इफ यू ऑब्जर्व द कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज, interest, why interest is added back? Interest is added back because we are calculating the unlevered cash flow. जो नेट प्रॉफिट ऑपरेटिंग प्रॉफिट है, जो प्रॉफिट एंड लॉस स्टेटमेंट है, उसमें इंटरेस्ट जो है वो ऑलरेडी डिडक्टेड होगा, इंटरेस्ट डिडक्टेड होगा. पर हम इसको अनलीवर्ड कैश फ्लो, सिंस हम कैश फ्लो प्रायर टू डेट हम निकाल रहे हैं कि इसमें डेट और इक्विटी दोनों इंक्लूडेड है, इसलिए वो इंटरेस्ट जो है वो एड बैक होगा. तो इसलिए इंटरेस्ट को हमने ऐड किया और जो भी कैपिटल एक्सपेंडिचर है उसको माइनस किया. तो वो जो फर्म के पास होगा वो एक्चुअली वो है वो कैश फ्लो बचेगा. फॉर एग्जांपल कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज इज 800 crore. So we will add, and interest is added for interest expenses 30 and tax is 30% and capex is 300 crore. So 800 crore is the cash flow from operating activities plus 30 is the interest, tax is 30% and 300 crore is the capex, capital expenditure. So it is coming to 521 crores. 521 crores. So this is cash flow to firm. Now come to cash flow, free cash flow to equity. ये बहुत इंपॉर्टेंट है क्योंकि वैल्यूएशन ऑफ इक्विटी शेयर में आपको फ्री कैश फ्लो टू इक्विटी निकालना पड़ेगा अगर एज अ फंडामेंटल एनालिस्ट आप ये चाहते हैं कि फ्री कैश फ्लो लेना चाहिए. तो जनरली फ्री कैश फ्लो टू इक्विटी. नाउ द क्वेश्चन अराइजेस इज दैट your question may arrive in your mind कि किसी particular firm में whether an investor should follow the dividend based model, the equity based model or a free cash flow based model. Actually it depends upon the investor to investor and his perception. If an investor thinks that the company is declaring dividend on a continuous basis year after year, he may follow the dividend discount model. And if the investor thinks that a particular company is investing heavily, investing its retained earnings in other profitable projects and declare very few dividends, then the investor will be willing to follow the earning based model. And if the investor thinks that the company does not follow any fixed approach, sometimes it declares dividend, sometimes it retained earnings, and it has huge cash flow at its disposal, and it is investing in risky profitable projects. So in such situation, the free cash flow to equity method is considered as the best method. So it depends upon company to company and how the investor perceives as a company to be. So free cash flow to equity is calculated by this method: non-operating profit after tax plus depreciation minus capex minus net change in working capital. Net change working capital क्यों माइनस करेंगे? क्योंकि वर्किंग कैपिटल नेगेटिव में आ रहा है, इसका मतलब डे टू डे एक्सपेंसेस की रिक्वायरमेंट अगर ज्यादा हो रही है, उससे ज्यादा बोरोइंग हो रही है, तो वो फिर नेट कम हो रहा है, मीन्स जो वर्किंग कैपिटल का पेमेंट कर दिया गया है, तो जितना भी पेमेंट हो गया है दैट विल बी डिडक्टेड फ्रॉम द दिस total earnings. So any change in working capital should be deducted, and any new debt issued, would be added, and debt repaid should be deducted. न्यू डेट इशू होता है तो कंपनी के पास कैश आएगा तो वो भी ऐड करेंगे, एंड एनी डेट रीपेड वो भी इसको लेस करेंगे. अगर कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज लेते हैं तो सेम होगा, कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज. तो उसमें डिप्रिसिएशन को ऐड बैक करेंगे, कैपेक्स को लेस करेंगे, नहीं सॉरी कैश फ्लो होगा तो डिप्रिसिएशन को ऐड बैक हम उसको नहीं करेंगे. और कैश फ्लो फ्रॉम ऑपरेटिंग एक्टिविटीज में it will be capex will be deducted, plus new debt issued minus debt repaid. Okay, so this way free cash flow to equity will be calculated. And so what we understood from this free cash flow to firm is an unlevered cash flow, the cash flow which is available to the firm, and it includes both the debt and equity. And free cash flow to equity means the levered cash flow. The levered cash flow means the cash flow which is available to the equity shareholder excluding the debt. We will take one question, free cash flow to equity, in which the concept will be more clear to you. Now come to the next slide. Now come to enterprise value. So what is this enterprise value? Enterprise value is actually the true economic value of a company. It is generally considered as the acquisition value, means it is considered as the value at which other company may purchase it. So mergers and acquisition में enterprise value की बहुत importance है, क्योंकि enterprise value वही value है जिसपे कि एक दूसरी कंपनी एक पर्टिकुलर कंपनी को खरीद सके. सो कैसे कैलकुलेट करते हैं? एंटरप्राइज वैल्यू इज इक्वल टू मार्केट कैपिटलाइजेशन प्लस लॉन्ग टर्म डेट प्लस माइनॉरिटी इंटरेस्ट माइनस कैश. तो इसमें जो enterprise value is considered as a true value, but in this case not only the value of equity shares is considered, also the value of long-term debt is also considered, and in this case the minority interest is also added and cash equivalents are deducted from them. In this case, students, it is worthwhile to understand the concept of minority interest. Why minority interest is added? Minority interest is the value of subsidiary not owned by the holding company, not owned by the parent company. So this portion, this market capitalization plus long-term debt, it is considered the total value of the parent company. And in case of the consolidated balance sheet, all the values of subsidiaries are also been taken into account. But what about the subsidiary which are not owned by the parent company? So that value should also be included. That is why the minority interest is the value which the subsidiary not owned by the parent company is also added to this enterprise value. It is added to enterprise value to show the equity value of the subsidiary that the parent company does not own. So there can be a just comparison when it is compared with earning before interest and tax, depreciation and amortization. Cash and cash equivalents are deducted. ये जो है वो डिडक्ट किए जाते हैं कैश एंड कैश इक्विवेलेंट. क्यों डिडक्ट किए जाते हैं कि जो कैश जो है वो एक्सपेंसेस है, तो एक्सपेंसेस जो है ऑलरेडी चले जा रहे हैं, फिर उनको फिर ऐड करने की जरूरत नहीं है. तो मार्केट कैपिटलाइजेशन और लॉन्ग टर्म डेट को तो ऐड किया ही जाता है, माइनॉरिटी इंटरेस्ट को भी ऐड किया जाता है कि जिसमें जिस कंपनी के वैल्यूज जो सब्सिडरी कंपनी को पेरेंट कंपनी नहीं ओन करती उसकी वैल्यू को भी ऐड किया जाता है, और जो कैश एक्सपेंसेस हैं कैश एंड कैश इक्विवेलेंट उसको माइनस किया जाता है. दैट इज द बेसिक कॉन्सेप्ट ऑफ द एंटरप्राइज वैल्यू. Enterprise value is compared to sales also, and enterprise value compared to EBITDA, that is earning before interest and tax, depreciation and amortization. Now come to this slide, enterprise value to sales. Enterprise value to sales is used to measure the price an acquiring company is willing to pay in terms of its sales. A low ratio indicates that a company is undervalued and is attractive to purchase. On the other hand, a higher ratio indicates that the company is expensive to purchase. It can also be used with companies having negative free cash flows. So low ratio, अगर ratio low है enterprise value, इसका मतलब enterprise sales के comparison में enterprise value उतनी ज़्यादा नहीं है. So then it indicates that it is an undervalued company and it is attractive to purchase. अगर enterprise value की ratio अगर ज़्यादा है in comparison to sales, इसका मतलब वो undervalued company है, overvalued company है और उसको attractive नहीं है purchase करने के लिए. Enterprise value is also compared to earning before interest and tax, depreciation and amortization. And EBITDA is commonly known as the amount available to debt and equity shareholders of a company. This multiple is used for valuing capital intensive companies, which generally have substantial depreciation and amortization. तो जो कंपैरिजन किया जाता है एंटरप्राइज वैल्यू से EBITDA का, वो उस कंपनीज में किया जाता है जो कि कैपिटल इंटेंसिव कंपनीज है, जिसमें बहुत सारा ज्यादा कैपिटल लगता है, जैसे मैन्युफैक्चरिंग कंपनीज है, और वो सब्सटेंशियल डिप्रिसिएशन और अमोर्टाइजेशन एक्सपेंसेस होते हैं. उनके लिए कंपैरिजन जो है वो बेटर है एंटरप्राइज वैल्यू टू EBITDA. अदरवाइज दूसरे कंपनीज के लिए ये वैल्यूएशन जो है कंपैरिजन एंटरप्राइज वैल्यू टू सेल्स ज्यादा उपयोगी है, ज्यादा फ्रूटफुल है. Now come to valuation of the right shares. As we know, the company offers the right shares to the existing shareholders. So what is the right share? Right share is the share which the company issues to the existing shareholders of the company at a discount rate also. And generally it is first offered to the existing shareholders. If the existing shareholders say no, then it is offered to the outsiders. So it is basically a benefit which is given to the existing shareholders of the company. So how the right shares are valued? It is value is called the price of share immediately after the right issue. After the right issue, the price of share is called X right price or theoretical X right price, which is computed as follows. By this way, it is calculated. NP0 plus S upon N plus N1. N is the number of equity shares. P0 is the price of share free right issue. S is the subscription amount from the right issue, and N1 is the number of equity shares offered. I will take a brief example so that in this case the concept is clear. This formula NP0 plus S upon N plus N1. So this is the actually price of the existing shares. This is the value of the existing equity shares. And this portion is the value of right shares. This is the value of right shares. So it will be, this portion is number of right shares multiplied by the price. Multiplied by the price of the right issue. N is the number of existing equity shares and it is number of the new shares offered. New shares offered means the right issue. So this is basically the theoretical X right price, means what will be the price of the company after the right issue. So the total market value of the existing equity shares plus the total market value of the right equity shares are added and multiplied by the total number of shares, that is total number of equity shares and the total number of right shares. So first of all, let us take an example so that it can be more clear to you, this formula. Let us say, valuation of right shares. Let us say number of existing equity shares is 1 lakh. Price of existing equity shares is say rupees 100. Right issue is 2:1. It means for every existing equity shares, half shares will be issued, or for every 2 equity shares 1 equity shares will be issued. इसका मतलब कोई अगर 100 shares होल्ड कर रहा है तो उसको 50 shares मिलेंगे 2:1 के रेशियो में. Now, right shares offered is equal to 50,000. 2:1, क्योंकि 1 लाख एग्जिस्टिंग इक्विटी शेयर होल्डर है तो उसको 50,000 मिलेंगे. अगर कोई 2 इक्विटी शेयर, किसी के पास 2 इक्विटी शेयर है, उसको 1 शेयर मिलेगा. तो 1 लाख शेयर होंगे तो हाफ कर देंगे तो उनको 50,000 राइट शेयर्स इश्यू होंगे. जो राइट इश्यू का प्राइस है वो लेटेस्ट से ₹40. ओके, नाउ अप्लाई दिस फॉर्मूला. Apply this formula. NP0 plus S upon N plus N1. N is the number of existing shares multiplied by ₹100 existing price of equity shares plus number of right shares issued 50,000. The right shareholders will get, and the price is ₹40. So it will be divided by the total number of existing shares, which is 1 lakh, plus number of right shares, 50,000. So let us calculate it. It will be about 1 crore. And 50,000 into 40, it will be 20 lakh. 20 lakh. It will be divided by 1,50,000. So it will be so the value of right shares is coming, theoretical right price is coming to 80. Theoretical right price is X right price is 80 after the issue of the shares. I think it will be clear to you. Now, again, get back to the slide. I think now this portion is clear to you. Go to the slide first, valuation of right shares. So what we have calculated till now, we have calculated the theoretical X right price. We have calculated the price. Now we have to calculate the value. So theoretical value of right is equal to X right price minus subscription price. X right price minus subscription price. So value of right shares is equal to X right price minus subscription price. X right price minus subscription price. So what is the X right price? We have calculated. It is rupees 80. So it will be rupees 80 minus what is the subscription price? Excuse me. The subscription price in this case is rupees 40. So it will be rupees 80 minus rupees 40. So the value of right will be, it is coming to rupees 40. So in this way, the valuation of right shares has to be done. I will take a question on the assignment also. On this concept will be more clear. So just try to, you can say, solve this question, revise it also, so it will be more clear to you. This is the portion. Now come to the valuation of the preference shares. What are the preference shares and how does it differ from the equity shares? Preference shares are those shares in which the dividend declared to the shareholders is fixed. And in case of winding up of a company, first of all, the payment is made to the preference shareholders. So preference shareholders have a preference to dividend and the preference to capital in the case of winding up of a company. That is why they are called preference shares. So how to value this preference shares? This can be done in two ways: valuation of redeemable preference shares and the valuation of irredeemable preference shares. The valuation of redeemable preference shares, the concept is very similar to the valuation of equity shares, but it is more simpler in approach. Why? Because the dividend is fixed every year. So if you can recall, in case of valuation of equity shares, we have calculated you can say fixed growth rate, fixed dividend, constant dividend. So constant dividend approach will be followed, that every year the dividend will be same in case of redeemable preference shares. So in preference shares, the dividend are fixed. That is why it is more easier. You can say easier to calculate in comparison to valuation of equity shares. So dividend, first year dividend, it will be discounted to arrive at the present moment. So this R is basically the discount rate, in this case KE, which we have taken in the valuation of equity shares. So this is dividend 2. It is dividend at the end of the second year, and R is the cost of dividend. The cost of equity capital, so cost of dividend will be the actually the dividend declared. It will be continue so on, and then for the last period, because the preference shares are issued for a particular fixed period. For example, if the preference shares are issued for 10 years, so this maturity will, this N will be actually 10. Maturity value will be at the end of the 10th year. Now let us take a brief example so that you can understand this, the valuation of redeemable preference shares. Valuation of redeemable preference shares. So in this case, the P0 is calculated as, you can say, D upon 1 plus R, D upon 1 plus R2 plus D3, 1 plus R3, and so on till maturity. And on maturity, it will be, for example, it is for 10th period. So it will be D10 plus the maturity value divided by 1 plus R10, it will be. Okay. So let us take a brief example. Let us say face value of a company is rupees 10,000. Dividend is 12%. Redeemable. Okay. In this example, face value is 10,000. Dividend is 12%, and it is redeemable after 3 years. And the required rate of return, is, say, 15%. So now let us calculate it by applying the formula. So P0 is equal to D. Is for 3 years, so it is 10,000 into 12%. It will be 1,200. So dividend will be 1,200. So 1,200 divided by 1 plus R, that is 0.15, plus second year 1,200 upon 1 plus discount factor 15%, plus third year on third year it is redeemable preference shares are. So 1,200 plus entire value, that is 10,000 divided by 1 plus 0.15 the power 3. So let us solve it. 1034.48 plus 1200 so it will be 1200 divided by 1.32 plus 1200 plus 10,000 11,200 divided by 1.52. So it will be basically 1034.48 plus 1200 divided by 1.32. 909.09 and it will be 11,200 divided by 1. And 1 second, okay. Okay, so 11,200 divided by 1.52 is coming to 7368.42. So let us add it 1034 plus 909.09 plus 7368.4 is coming to about 9311.51. So this is the value of the present value of the future dividends in case of redeemable preference shares. So how we approach this question? Simple example, face value 10,000 is given, dividend is 12%, and it is saying in the question that dividend is redeemable after 3 years, and required rate of return, that is discount rate, is 15%. So we taken the future dividend as 1,200 and discount it by the discount rate of 15% to arrive at the present value. Dividend of first year 1,200 discounted by the 15%. Then dividend of second year is also 1,200. Dividend of third year will be 1,200 plus the redeemable value, because 10,000 will be returned to the investors at the end of the third year. So 1,200 dividend plus 10,000 the face value which will be returned to the investor, that is 10,000. So total value will be 11,200. So all these value are discounted to arrive at the present value now, in which the investor will be willing to invest, which is coming to 9311.51. Now, valuation of irredeemable preference shares. The valuation of irredeemable preference shares is even more easier. It is dividend upon the required return on preference shares. Irredeemable preference shares means the preference shares will not be redeemed to the shareholder. Means एक बार अगर preference share issue हो गया तो वो पैसा जो है preference shareholders को वापस नहीं होगा. That is why irredeemable. The difference क्या है redeemable preference shares और irredeemable preference shares? Redeemable preference share एक certain number of years के लिए issue होता है. 5 साल के लिए, 10 साल के लिए, 15 साल के लिए. Okay, and irredeemable preference share means which cannot be redeemed. But now, as per the Companies Act, companies can issue redeemable shares, irredeemable preference shares for a maximum of 30 years. तो 30 years से ज्यादा के लिए irredeemable वो नहीं हो सकता था. अभी as such irredeemable का कोई concept नहीं है. पर as a theoretical value, अगर irredeemable preference shares को value करना हो, उसकी value होगी dividend upon required return on preference. Dividend लिया गया क्योंकि ये dividend है वो that will be fixed every year. So if we can take a particular example, whatever example in this case also, the dividend is fixed, for example, 1,200. It will be divided by the required rate of return, which is 15%, 0.5. So what will be the value? 1,200 divided by 0.15. The value will be 8,000. So generally we see that the value in case of irredeemable preference share is less in comparison to redeemable preference shares. Obviously, because the maturity amount is generally returned to the preference shareholders. So it is more attractive to the shareholders, this redeemable preference shares. So this is what about this valuation of equity shares. So how we have proceed? We have initially taken some of the concepts of the valuation of equity shares, such as required rate of return, discount rate, internal rate of return, and cost of this, you can say, equity risk premium. A very important concept we have understood in this lecture, that is equity risk premium and the market risk premium. We have also understood that the cost of equity is calculated by two methods, by Gordon's method as well as by capital assets pricing model also. What is the difference between these two? In Gordon's method, while valuing cost of equity shares, the risk is not considered. While in case of capital asset pricing model, the risk is considered. In which cases the capital asset pricing model is used? Capital asset pricing model is used in case of those companies which are investing in risky, profitable growth opportunities. So in that cases, capital asset pricing model is used. We have also see the calculation of the market risk premium and the equity risk premium. What is the difference between these two? Market risk premium means whatever the shareholders want return in excess of the risk-free return. That is why risk premium. Whatever risk they are taking, they want certain premium on it. For example, if the risk-free rate is 8 and the market return is 10, then 8 minus 10 minus 2, 10 minus 8, 2 is the market risk premium. We have seen with the help of an example also. And in case, what is the equity risk premium? Equity risk premium is the, you can say, the return which the equity shareholders want by investing in the risky equity shares. So equity risk premium is basically the beta into this RM minus RF. So this portion is the equity risk premium, and this portion, that is RM minus F, only this portion RM minus F is the market risk premium, It is the market risk premium. We have seen with the help of the examples also. Then we come to the three different methods of valuing equity shares: dividend-based model, earning-based model, and free cash flow. In dividend-based model, basically Gordon's model is followed. How the equity share is valued? The equity share is valued by calculating estimating the future dividends on the basis of the past and present dividends, and then discounting it at a discount value to arrive at the present value. If we have seen by the practical examples, if the equity shares are held for 1 year, then how it is calculated. And then another method is a multiple holding period. If the shareholders want to hold the equity shares for a long period of time, then there are three different approaches. First approach is that if the dividend is constant every year. For example, company अगर 10 रुपए का डिविडेंड डिक्लेयर करती है तो हर साल 10 रुपए डिविडेंड डिक्लेयर कर रही है, पहले साल भी 10 रुपए, दूसरे साल भी 10 रुपए, तीसरे साल भी 10 रुपए, ऐसे चलता है. ठीक है, तो zero growth rate और constant dividend model. सेकेंड एस्पेक्ट इज कॉन्स्टेंट ग्रोथ रेट, मीन्स कंपनी अगर 10% डिविडेंड इंक्रीज कर, हर साल 10% इंक्रीज कर रही है, फर्स्ट ईयर भी 10% इंक्रीज कर रही है, फॉर एग्जाम्पल दूसरे साल भी 10%, तीसरे साल भी 10%, ये चलता है। तो पहले जो दो मेथड है दैट इज इम्प्रैक्टिकल। प्रैक्टिकल सिचुएशन में इस तरह की सिचुएशंस नहीं आती, इस तरह के पॉलिसीज कंपनी फॉलो नहीं करती है। प्रैक्टिकली क्या होता है, कंपनी हर साल डिविडेंड अलग अलग डिक्लेयर करती है। पहले साल अगर 10% डिक्लेयर किया है तो दूसरे साल कम करेगी, 8% करेगी, 6% करेगी। अगर उसके पास प्रॉफिटेबल ग्रोथ अपॉर्चुनिटीज नहीं होगी, प्रॉफिटेबल ग्रोथ अपॉर्चुनिटीज होगी, अगर उसके पास प्रॉफिटेबल ग्रोथ अपॉर्चुनिटीज सॉरी इसमें प्रॉफिटेबल ग्रोथ अपॉर्चुनिटीज अगर होगी तो कम डिक्लेयर करेगी, तो प्रॉफिटेबल ग्रोथ अपॉर्चुनिटीज नहीं होगी तो ज्यादा डिविडेंड डिक्लेयर करेगी, 10%, 12%, 13%, इस तरह से बढ़ाती रहेगी। तो प्रैक्टिकली इस तरह से होता है। इसीलिए थर्ड सिचुएशन जो आता है वो है वेरिएबल ग्रोथ रेट डिविडेंड। इसमें हम लोगों ने देखा 2 स्टेज डिस्काउंट मॉडल एंड 3 स्टेज डिस्काउंट मॉडल। 2 स्टेज डिस्काउंट मॉडल में क्या होता है, इट इज जनरली assumed that for the first few years the company growing at exponential growth rate. For example, कंपनी 10% ग्रोथ रेट है, 3 साल तक 10% ग्रोथ रेट रहेगा, उसके बाद फिर वो 5% पे आ जाएगा, 5% पे आ जाएगा, फिर वो कंटिन्यूअस 5% जो है इनफाइनाइट पीरियड तक होगा। क्यों ऐसा क्यों माना जाता है? बिकॉज दिस इज द बेसिक assumption of Gordon's growth rate model that after a certain level an investor has to assume that the dividend will grow at a certain percentage for a infinite period of time or for a long time to come. For example, अगर ये माना जाता है कि डिविडेंड ग्रोथ रेट एक्सपोनेंशियली ग्रोथ कर रही है 10% रेट से पहले 3 साल, 3 साल के बाद थोड़ी मैच्योरिटी आएगी तो डिविडेंड ग्रो करेगी 5% से 5% से till infinity for a long time to come. So this is basically the 2 stage dividend discount growth model. 3 स्टेज में क्या होगा, बेसिक कॉन्सेप्ट वही है, पहले कुछ साल तक हाई ग्रोथ रेट डिविडेंड रहेगा। फॉर एग्जांपल, पहले 5 साल तक डिविडेंड 10% से ग्रो कर रही है, उसके बाद नेक्स्ट 3 इयर्स में 2% से लेस हो रही है, उसके बाद एक पर्टिकुलर ग्रोथ रेट पे, जैसे 8 फॉर एग्जांपल 8% पे वो टिल इंफिनिटी फॉर लॉन्ग टाइम टू कम उस रेट पे ग्रो करेंगे। तो हमने इस चीज को एक एग्जांपल से भी देखा है। तो 3 स्टेज ग्रोथ मॉडल में जो कैलकुलेशन का मेथड है, जो अप्रोच है, वो सेम है जो कि हम 2 स्टेज डिविडेंड ग्रोथ मॉडल में फॉलो करते हैं। उसके बाद हम लोगों ने देखा अर्निंग बेस्ड मॉडल। अर्निंग बेस्ड मॉडल गॉर्डन का ही मॉडल है। Basically, in place of dividend, the earning is based. In which situation the earning-based model is followed? Earning-based model is followed when the company is not willing to declare dividend every year. It wants to forego dividend and apply the funds which are available by way of retained earning in profitable growth. So, earning-based model इन्वेस्टर कब फॉलो करना चाहेगा? जब उसके पास प्रॉफिटेबल ग्रोथ अपॉर्चुनिटी ज्यादा है, तो उसमें वो डिविडेंड डिक्लेयर नहीं करेगा। वो क्या करेगा, जो भी प्रॉफिट बचेगा उसका इस्तेमाल वो नए ऐसे प्रॉफिट ग्रोथ अपॉर्चुनिटीज में करेगा, ऐसे प्रोजेक्ट्स में करेगा जिसमें उसकी प्रॉफिट फ्यूचर में और इंक्रीज हो सकती है। तो इन दैट सिचुएशन द अर्निंग बेस्ड मॉडल इज फॉलोड। डिविडेंड बेस्ड मॉडल इज फॉलोड व्हेन द कंपनी इज एक्सपेक्टेड टू डिक्लेयर डिविडेंड ईयर आफ्टर ईयर, एवरी ईयर। Then the third approach we have seen free cash flow approach. Free cash flow method में क्या होता है? Free cash हमने देखा, free cash flow to firm, free cash flow to equity. Free cash flow to firm is basically the unlevered cash flow. Unlevered cash flow means the cash flow which is available to the company. तो कंपनी को जो कैश फ्लो अवेलेबल होगी वो डेट भी होगा, इक्विटी भी होगा, दैट इज व्हाई अनलीवर्ड। जो कैश फ्लो इक्विटी शेयर होल्डर्स को अवेलेबल होगा वो लीवर्ड कैश फ्लो होगा, मतलब वो सिर्फ इक्विटी शेयर्स में होगा, उसमें डेट नहीं होगा। तो दैट इज द बेसिक डिफरेंस बिटवीन दीज टू कैश फ्लो, फ्री कैश फ्लो टू फर्म एंड फ्री कैश फ्लो टू इक्विटी। We have seen how the free cash flow to firm is calculated, how the free cash flow to equity is calculated with help of examples also. I will give you an assignment question on this free cash flow. In this, it will be more clear to you. Then we come to the concept of enterprise value. Enterprise value is the value at which the other company wants to, a particular company wants to acquire another company. तो एंटरप्राइज वैल्यू एक मर्जर्स एंड एक्विजिशन में इसकी काफी अहमियत है, काफी इंपॉर्टेंस है. तो ये वो प्राइस होता है, वो वैल्यू होता है जिसमें एक कंपनी दूसरे कंपनी को खरीदना चाहती है. व्हाट इज एंटरप्राइज वैल्यू, को कैसे कैलकुलेट करते हैं? एंटरप्राइज वैल्यू इज इक्वल टू मार्केट कैपिटलाइजेशन, मींस मार्केट कैपिटलाइजेशन ऑफ इक्विटी शेयर्स प्लस डेट प्लस माइनॉरिटी इंटरेस्ट माइनस कैश एंड कैश इक्विवेलेंट्स. तो इसमें ये नहीं कि सिर्फ इक्विटी शेयर्स को ले लिया जाता है, इसमें ये एंटरप्राइज वैल्यू का कॉन्सेप्ट काफी ब्रॉड है. इसमें जो लेटेस्ट मार्केट वैल्यू इक्विटी शेयर्स की ली जाती है, डेट की वैल्यू ली जाती है, माइनॉरिटी इंटरेस्ट को भी ली जाती है. माइनॉरिटी इंटरेस्ट क्या होता है? माइनॉरिटी इंटरेस्ट इज द वैल्यू which the subsidiary, which the parent company does not hold in the subsidiary company. तो सब्सिडरी जो सब्सिडरी कंपनी ओन नहीं करती है पेरेंट कंपनी, उसकी वैल्यू जो है वो माइनॉरिटी इंटरेस्ट है. तो माइनॉरिटी इंटरेस्ट को भी ऐड किया जाता है एंड कैश इक्विवेलेंट इज डिडक्टेड बिकॉज इट इज ऑलरेडी द एक्सपेंसेस, दैट इज व्हाई इट इज डिडक्टेड. So this way the enterprise value is calculated, and this enterprise value is compared with the sales also. If the enterprise value in comparison to sales is lower, then it can be said that the company is undervalued and attractive. Undervalued मतलब कंपनी की वैल्यू कम है. अगर कंपनी की वैल्यू कम है तो इसका मतलब वो अट्रैक्टिव है. इन्वेस्टर्स फॉर एग्जांपल होप कर रहे हैं कि कंपनी वैल्यू जो है उसकी 100 होगी, 100 करोड़ होगी, पर उसकी कंपनी एक्चुअली 80 करोड़ है, अंडर वैल्यूड है. तो ये 80 करोड़ ऑब्वियसली अट्रैक्टिव है, ये चीप है, तो खरीदने में कम पैसे लगेंगे. देयरफॉर इट इज व्हेन अंडर वैल्यूड कंपनी इज अट्रैक्टिव. उसी तरीके से अगर एंटरप्राइज वैल्यू और सेल्स का कंपैरिजन उसमें ज्यादा है, फॉर एग्जांपल एंटरप्राइज वैल्यू काफी ज्यादा है सेल्स के कंपैरिजन में, देन इट इज अ ओवर वैल्यूड कंपनी. कंपनी की वैल्यू काफी ज्यादा है और वो अट्रैक्टिव नहीं है खरीदने के लिए. फॉर एग्जाम्पल अगर कंपनी की वैल्यू 100 करोड़ होनी चाहिए तो वो 120 करोड़ है, ओवर वैल्यूड है, तो उसको इन्वेस्टर्स नहीं खरीदना चाहेगा. तो इसलिए एंटरप्राइज वैल्यू और सेल्स की कंपैरिजन जो है इंपॉर्टेंट होती है मर्जर्स एंड एक्विजिशन के सिचुएशन में. उसके बाद एक और कंपैरिजन होता है एंटरप्राइज वैल्यू का, अर्निंग बिफोर इंटरेस्ट एंड टैक्स डिप्रिसिएशन एंड अमोर्टाइजेशन, एबिटा. तो एबिटा का कंपैरिजन भी उस सिचुएशन में किया जाता है जिसमें कंपनी का बहुत सारा पैसा, काफी कैपिटल लग रहा है. जैसे मैन्युफैक्चरिंग कंपनीज है, मैन्युफैक्चरिंग कंपनीज में कैपिटल बहुत ज्यादा लगता है. तो इन सच टाइप ऑफ कंपनीज, कैपिटल इंटेंसिव कंपनीज, where the depreciation expenses and amortization expenses is more, the comparison to enterprise value to EBITDA is made. उसके बाद हम लोगों ने देखा वैल्यूएशन ऑफ राइट शेयर्स. तो राइट शेयर्स को कैसे वैल्यू करते हैं? राइट शेयर्स क्या होते हैं? राइट शेयर वो शेयर्स होते हैं जो कि एग्जिस्टिंग इक्विटी शेयर होल्डर्स को इशू किए जाते हैं, कम पैसे पे डिस्काउंट भी इशू किया जाता है, वो राइट इशू होता है. राइट शेयर का वैल्यूएशन हमने देखा एग्जांपल से. I will give a particular question in the assignment also, in which it will be more clear. In last, we have seen the valuation of preference shares. It is easier in comparison to valuation of equity share because equity shares में क्या होता है, डिविडेंड फिक्स भी रहता है, डिविडेंड बढ़ भी सकता है, डिविडेंड हर साल चेंज भी हो सकता है. हमने अलग अलग सिचुएशन देखे. प्रेफरेंस शेयर्स में क्या होता है, डिविडेंड फिक्स्ड होता है. There are two methods: valuation of redeemable preference shares and valuation of irredeemable preference shares. Redeemable preference shares में preference shareholders को redeem कर दिया जाता है, मतलब जितना पैसा लिया जाता है preference shareholders को उनको वापस कर दिया जाता है. That is why it is called redeemable preference shares. तो redeemable preference shares को हम एग्जांपल से देखा कि कैसे कैलकुलेट करते हैं. फिर हम आए valuation of irredeemable preference shares पे. Irredeemable preference shares means वो प्रेफरेंस शेयर्स जो कि रिडीम नहीं होते, जिसमें कि जो पैसा प्रेफरेंस शेयर होल्डर से लिया गया है कंपनी उसको वापस नहीं करती है. दैट इज व्हाई इररिडीमेबल प्रेफरेंस शेयर्स. हमने भी इसको सिंपल एग्जांपल से देखा कि इररिडीमेबल प्रेफरेंस शेयर्स को कैसे कैलकुलेट करते हैं. तो ये है वैल्यूएशन ऑफ इक्विटी शेयर्स. इवन इफ यू हैव एनी क्वेरी, एनी डाउट, यू कैन ऑलवेज आस्क. You can mail us at sfm-final@icai.in, and you can also call that as this phone number 0120-3045-956. So, students, thank you for your patient listening, and show that this portion of valuation of equity shares is interesting to you. Thank you so much.